Introducing the new DocsTradingPost.com, your online survival superstore for the lowest priced guns, ammunition, and optics available online. Prepare today at DocsTradingPost.com. This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us this week is a special guest, the silver guru himself, David Morgan. It's great to have you back, David.
Well, thanks for having me.
Well, it's always a pleasure. It's been a few months since we've had you, and it really is a good time market-wise to have you back here. It's been quite a summer for silver and gold as we head towards the fall here. This week, really most of the trading action here on Friday with a smash down just after the COMEX open. Both gold and silver retraced all of their losses throughout the afternoon session in the access market trading. So why don't we start out here a little bit, David, with your take on where we're at right now in the metals. I know we were just chatting before the show started that you advised that if someone would have told you back in 2011 that silver would be looking at nearly an 80% correction, you would have bet, what'd you say, about half your house that wouldn't have happened. Is that right?
Yeah, I did make that statement. I really thought the worst we would see would be about a 50% retracement, especially knowing we're still in a bull market. But, and I'm not a big Fibonacci retracement guy, but that's the number's around 78%. And here we are, roughly that number. But I think, John and Eric, the thing to outline is, what we've talked about again pre-show, and that's a show I did recently with USA Watchdog, and talking about the physical demand for silver in the retail market. And if you sum total everything that's backlogged, you're looking at roughly 5 million ounces. I mean, the mint can't supply the demand. The Sunshine Mint, and you did a great interview with Tom Powers, and as a side issue, I've known Tom for a very long time. I've been through the Sunshine Mint 3 times. In fact, as a sideline, I was actually one of the auditors for Bernard von Nothaus way back in the Liberty Dollar days when he first got started and stored at Sunshine Mint. So anyway, that was a great interview, so I want to thank you both publicly for doing that. But the situation right now is that there's a backlog, and roughly 5 million ounces, as I just said. It's across the board in retail product, from rounds to bars to obviously government minted coins and junk bags especially, which I'll emphasize because there may be people out there that didn't hear the Greg Hunter interview. And the coin bag market, or junk silver as it's referred to in the industry, is a very good leading indicator. And we put that in the Morgan report about 2 months ago that the premiums were starting to go up in the bag market. It's not a terrific timing indicator, but it's a good indicator. In other words, when the bag premiums go up, it's a good indicator that within a month, 2 months, 3 months type of thing, you're going to start to see a bottom in the market, and you're going to see silver prices across the board go up. So we noted that. And now the bag market has a premium of almost $5 per ounce on the wholesale side, which means if I'm out there as a wholesaler and I'm going to sell to SD Bullion, for example, I am going to charge you guys like the $5 for you to mark up beyond that in order to make a profit on that product. I don't want to make a big, huge case of the silver bag market, but, being in this market for like 4 decades, it's one of the strangest markets I've ever seen. And so I'd like to just go on from there because there's a difference between congestion or shortage in the retail market and shortage in the silver market, which means if we have to factor in the commercial bar inventory and what the availability is there, then we're getting the total picture. So I started thinking a little more about this. And if we go back to when Eric Sprott started the PSLV, I actually was asked to come up and visit in Toronto. And I did. And they had a few questions for me about how they were going to structure, not so much how they're going to structure, where they're going to actually market the PSLV, where they're going to keep it in Canada only, or they're going to move it in the U.S. And of course, I was asked, and I told them, I said, you've got to include the U.S. market, which they did, of course. But when he made his first initial purchase, it was for 22 million ounces. And it took quite some time, much more than promised, to deliver all of that silver into the PSLV. And those were 1,000-ounce bars bought for investment purposes, obviously. So I started thinking, we're at a 5 million ounce backlog right now. But what if silver investors just kept buying and that backlog became 10 million, 15 million, 20 million? At what point would it start to stress the commercial bar market? Because let's face it, as I just said a moment ago, I've been through the Sunshine Mint 3 times. And what do? Well, they take a 1,000-ounce bar, they put about 3 or 4 pennies worth of copper on top of it, and they smelt it down, and then they extrude it, and they put it in a plate, and they do all the stuff. And the process may be slightly different now. It's been years since I've actually been through the entire process, top to bottom, but that's what they were doing the last 3 times I was there. And regardless, it's the commercial bar is the raw stock from whence the silver blanks come through. So my point is, and I'll try to be succinct now, is at what point does the retail market put stress on the underlying commercial market? And the answer is no one knows, but it could happen. And I just encourage everybody to take advantage of these low prices.
Now, David, when you say 5 million ounce backlog in silver, are you speaking strictly North American market or what?
That's pretty much North American market, and thanks for asking that. I don't know what the overall is, and of course it's a wag. Oh, it's more than a wag. It's an educated guess, but I think it's actually conservative.
Yeah, and certainly, I mean, it was just reported that India scarfed down 1,400 tons of silver last month in imports. I mean, the global import of silver is just going berserk at this stage.
Absolutely, and we might touch on that point. I mean, people that have followed my work for a long time know that India was a huge silver importer for year after year. And it wasn't until more recent times when it became wealthier and their middle class started to expand that they started to import, more and more gold, which is fine. They love both gold and silver. But primarily the savings program for most Indians is silver bracelets around a woman's wrist. I mean, that's the way they save in India. And that's their tradition. And as they've modernized, has that gone away? No, it hasn't gone away. Has it been substituted with gold and bank accounts? Yes, it has. But you look at, as you said, the amount of silver that's being imported by India. I think they're going back to their roots for whatever reason, either monetarily, instability in the financial system globally, or what have you. It doesn't really matter. Silver never asks, why am I being bought? It just is bought, and it's been bought in quantity in India again. And these trends are very positive to the market.
Yeah, back in January when India started to escalate their purchases, people were estimating they would import 7,000 or 8,000 metric tons of silver, and at this stage, given what they just did last month, they're on target to pull down maybe as much as 10,000 metric tons of silver this year, the most that they've reported, the most they've imported probably ever in a single year.
Exactly. The one thing I wish we would see as silver investors is someone else besides India step to the plate, like the PSLV I just mentioned, or maybe Central Fund of Canada, or maybe one of the what I call holding companies that actually doesn't play any games in the paper market and buys physical and stores it for their investors. And that could happen, certainly, but we haven't seen it. And with these low prices, it seems awfully tempting that somebody would step up to the plate and buy at these levels.
Yeah, it reminds me of conversations we've had with Eric Sprott previously, where when we have been in conversations that have taken place in the last 18 months, give or take, and we obviously had lower silver prices then, not as low as we are now, but we would ask him, well, in a roundabout way and diplomatically, do you think that there'd be a possibility that you'd do another offering for PSLV? Because the prices are here and interest is remaining. I mean, we have a tight retail market, and presumably people would also be interested in PSLV too. But one of the things that he noted, both of us and in other interviews I've heard with him, is that in terms of being able to source the actual silver, that would be a huge problem to actually do a secondary offering. I mean, it would be difficult to even do something of scale and significance to have a secondary offering. Very tight market.
Exactly, and that's what everyone really wants to know is how tight is it? I know it's extremely tight just by the retail demand, and then how much further down the rabbit hole does it go? Meaning, how much pressure really exists in the commercial bar market, and there's no answer, but I'll give you some clues from my long years in this market. I have noted twice before that when the registered category, the dealer inventory on a COMEX gets to 35 million ounces, all heck breaks loose. Now we're not there yet. In fact, we're quite a bit from there. But as I said a moment ago, if some big purchaser came in, or even the retail market put in 20 million ounce demand, you're down to that level. And so I'm watching, as I always do, carefully what the commitment of traders looks like and what the actual inventories are. And there's been a big build into the COMEX the last few years, which is very surprising to me after what's happened in the futures market with some of these characters that get away with, as far as I'm concerned, with fraud. And it is unnerving to me that some people would trust some of these entities with their physical silver, but nonetheless, the build into the banks, which are noted to be warehouses, they're really vaults that hold are approved by the CME to hold silver. That inventory has increased dramatically over the last few years.
Mm-hmm. What do you think about the change in the open interest in COMEX silver, where it wasn't all that long ago, maybe about 2 months ago, that we peaked at a level above 200,000 contracts, and now we're moving downward, and that's generally a healthy thing. A lot of people have been speculating that maybe that's an indication of some short covering by perhaps JP Morgan and whatnot. Do you think there's market signal intelligence there with respect to the open interest level?
Yes, I do. John and Eric, I used to pay a lot more attention to the COT than I do now, although I still look at it, and I look at it fairly frequently. But basically, the fundamentals you just outlined are exactly right. It goes to a large open interest, and the price is wherever it is. And there's a lot of paper shorts out there, and of course, there's a long for every short. I know that. But the commercials dominate the market and basically control the market and manipulate the market, and in kinder words, manage the market, because they have infinite money. So when the trading funds, who they're primarily going against, run out of money, whenever that happens and the market starts to move, then what happens is the trading funds have to cover. So it goes from a very large open interest to a lower open interest, and then the game starts over. So you go from a high open interest to a low open interest to a high open interest to a low open interest. Back in the early 2000s, that number was like 150 million ounces at the max, 150,000 contracts at the max, down to roughly 110 or so, or 100. So it was about a 50,000 ounce contract swing. And you could trade silver almost to the penny in those days. This is prior to the SLV. And now, of course, the open interest has gone up and up and up because there's more participants, but the basic idea is sound. And I'm probably elaborating too much for you guys, but that's exactly the idea. And it's frustrating because there are limits that the COMEX or the CME has, and they're basically just totally, completely, and absolutely ignored by the authorities. They just look the other way always and everywhere. And it frustrates somebody that knows that these rules are in place, and yet to prevent what's really going on. And yet, it's just after the investigations, they have no actionable findings. They didn't say it wasn't manipulated. They said they just didn't find anything actionable. Well, it's so hard to prove manipulation because these banks will just simply say, well, we're in there for profit, and that's why we did it, and we ran the stops. They'll just say it. We ran the stops, which means they're stealing money. Well, let me rephrase that. It means that they're moving the market because they have more monetary power than the other side, and that makes them winners, and they're taking money from the other side. And this just happens over and over again. And of course, as you guys well know,
helps when you know where those stops are at too.
They know where they're at, and it happens. You can set your watch on options expiration. It always happens on options expiration.
We wanted to give the listeners a little bit of an update, substantiating David's statements, and I concur with Eric. I think 5 million ounces of retail backlog is probably an understatement. If you look at just even one product like Silver Eagles, sales for the year are now up to 33.5 million ounces. The Mint sold 1.245 million ounces so far in September on their allocation, really about a week and a half's worth of allocation. Two of the top three wholesalers in the U.S. and the U.S. market, and when I'm talking authorized purchasers from the U.S. Mint, the one is pretty much sold through all the way through most of November's their expected allocations. So that's what from the allocations they're getting from the U.S. Mint every week right now. They've already sold through the amount of Eagles they expect to receive. I mean, you're talking the next 8 to 10 weeks, and that's assuming that the U.S. Mint doesn't provide them any hiccups and not deliver them any coins. And the other one is about that far along, and actually is now this week. I think it was Wednesday or Thursday. Their VP called me and told me, "Hey, John, our coins." Basically, they raised their coins to the price of one of the highest retail price dealers in the country, COMEX, basically telling us like, we got to stop orders. We have to we have to stop you guys from buying the coins. We're so backlogged. We're so far back in Silver Eagles that they're in 3 times a day weekly conference calls with their whole corporate team of how are they going to get to the end of the year and get all of their customers the coins they've already sold. And that's just one product we're talking about in Silver Eagles. Sunshine Products, which, again, we talked to Tom, their CEO, last week. I mean, we're talking about you place an order today, and I'm talking about a retail company that if you place a wholesale order today for Sunshine Products, they're estimating you're looking at around Christmas delivery.
Oh, my God. And for people who haven't heard that interview, what was one of the more fascinating points he made was that he was recollecting since 2011 they've seen year after year after year of expanding volume of their sales, and of course part of that is they're expanding international sales and serving as a producer for other mints and other retail products going into other markets. But it just reflects this very healthy retail demand that's not being adequately covered by the financial press because of the fixation of the paper market, magic machines of COMEX, etc., that are masking what's really going on in the retail market and beyond. And I mean, it was only the turn of this year that even HSBC was talking about an 8% supply deficit vis-a-vis mine supply coming into the market over the course of 2015. And meeting demand that would overcome it. We're sitting in this kind of eye of the hurricane where something's got to give. I mean, yeah, the price of production of silver has dropped a lot as energy has fallen, and I know, David, you were talking about with Greg Hunter that you believe that it's the price of production is now somewhere in the neighborhood of $15 per ounce in silver, if that's correct. Did I recall that statement correctly?
Yes, Eric, you're right. Correct. That's correct.
So, I mean, that helps take some pressure off of the goofy price mechanism and price discovery that we have dominated by the paper markets to some extent. But there's so much damage has been done with this 4-year-long bear market that a lot of supply is now being taken off the market, and on a going-forward basis, we're going to see that.
And what was really amazing to me is probably the past week to 10 days, the demand has calmed down and subsided on the retail level. I mean, it's still running at high levels, but compared to 2 or 3 weeks back, it's calmed down probably by 2/3, and yet we've still seen premiums rising pretty much daily across the wholesale level and retail level. I mean, all week premiums on everything have continued to rise. Availability continues to worsen and decline, and we saw another big spike today just on a I guess somewhat small dip. What was it, 30-40 cents in silver? I think silver was down about 30 cents this morning, and I've been saying since July, but I think last week I said that if we see silver break down below that 14 handle, it's going to get serious, and we're going to see 2008 style premiums. And at least for me, what I've seen this week, that's been substantiated with just incremental demand this week compared to what we've seen over the past month. And it's just the fact that everything is already gone and sold. So just any demand right now, it has the only pressure that can be relieved is to raise prices because it's all been sold through for the next 2 to 3 months. And if we saw any sort of further increase in demand, like you would see if we have new lows, and I mean today we had gold traded below 1100. It traded at a 10 handle again briefly, and I know Eric is a staunch opponent of the Shemitah cycle theory, and everybody freaking out about a crash from that. But if we had any sort of further weakness in gold, I mean the funds are still really short gold right now, and it's really turning into a battle between those who are looking at the physical and acquiring the physical, and the funds who really look like they're trying to push gold further and below that 1070 level.
All-time record lows in short positions for funds.
Right. I mean, the funds are trying to push gold lower, and if that happens, I mean, ultimately it's gonna come to a conclusion point probably on the FOMC and what happens. But if gold breaks lower, the paper market's going to drag silver with it, in my opinion, and it's going to get serious in the retail market as far as acquiring silver product.
Yeah, and the fund position is a contrary indicator. We should note that historically that's the way it has been.
Right.
Absolutely, Eric and John. I like to add there's subtleties that I've noticed, over the years, and I'm not the only one, of course, but we've noticed the gold-silver ratio actually has started to come back in silver's favor. I know it got the extreme of around 80, but for example, this week gold was off, I think, about 15, and doing this without in my head, and silver's about flat. And so we've had a few weeks now where silver has actually narrowed the gold-silver ratio back into the high 70s, but that's the move. In other words, it's showing a little more strength in gold. And that's one of the small subtleties that I look for a change in trend. In other words, for this bottom to finally be in. The other one, of course, is the premium on the bag market. And the last one, of course, or a few others, are the commitment traders, which is looking somewhat more favorable. And then, of course, I keep an eye on how low the registered category is on the COMEX. And I know there's people that don't believe any of these numbers. I tend to agree with what they put out in the warehouses. I think it's kind of impossible to fudge those numbers too much. Not to say that some of those bars that are resting in a certain category in the COMEX might not be shown on paper in an ETF somewhere. But nonetheless, I think the overall numbers at the COMEX are pretty legit. Having said that, I know there's a recent article on Zero Hedge that says, here is the disclaimer that's at the top of their nomenclature for what is in the warehouse. And I get that. I mean, if they're off one bar or whatever, that disclaimer would be valid. But, guys, it's almost a mystery that we can see this kind of demand and no talk at all in the mainstream financial press whatsoever. I mean, what a shock. Here we are at the best monetary metal the world's ever known, and I love gold too, but silver's been more transactions by far than any other metal in the history of mankind. And yet they're telling us, what Janet Yellen's going to be doing at the FOMC meeting. And the thing is, she's so lost, she doesn't know which end is up, but who knows what conclusion they're going to come to on this interest rate situation. I vote they probably won't do anything, but they probably will do something by the end of the year, but that's a guess.
Yeah, they'll probably try to do at least one interest rate hike just for the sake of saying, see, we tried to get our reputation preserved, and we're trying to do the right thing, but the markets just weren't going the right way, and it hurt the economy. So now, because we're data dependent and the economy is rolling over, of course, they're more interested in the asset positions of bank balance sheets and whatnot, and then the wealth effect. But they'll use the excuse of the economy turning down because consumer confidence hit the tank because the stock market fell. I was kind of hoping that the correction that we had in August would be a little bit more profound, such that they would be less waffling in their disposition. But who knows? We'll see. The markets are so highly valued at this stage, and the equities market and the bond market has already backed up quite a bit, particularly in the long end. And it's a question, in my opinion, as to when the Fed actually loses control and other central bankers lose control as to the missing ingredient for what will be the big one, quote unquote, and all of the people that are looking for September/October and the Shemitah cycle and all of that. I think that to a large extent we have probably 85% of the precious metals alternative asset community blogosphere space in the camp of expecting a giant correction and maybe the start of the absolute big one in September and October, and later on the Shemitah cycle on top of that. And by definition, that's not a black swan. Probably 15% of the conventional finance world that manages 95% of the money under management worldwide in the Western financial community is also looking for that kind of September, October mother of all, crashes. And that's part of the reason why I don't think that it's actually going to happen. I think we saw what has already come. Maybe we'll see continuation and peaking out 18-20% total correction from the peaks earlier this year, if in fact the Federal Reserve does raise rates on the 16th/17th of this month, because a lot of people have scaled back their expectations about that. If you look at Bloomberg surveys, for example, we went from over 50% of money managers expecting September being the incremental 25 basis hike to less than 30% now, given the correction we just moved through. So the shock value of the Fed potentially moving on the 16th, 17th is now a little bit more charged. The spring is more coiled because the expectations have been dialed back. So if they did hike in September, we probably see the return of spasm in the equities market by my eye and my work. But I'm not in a camp that believes that the big one is going to happen this year. And the main reason why is that too many people in the world still believe in this fantasy that the Fed and other central bankers have their back. And that's the missing ingredient for what would be a systemic crash. And it's the kind of thing that happened in 2008, even after Bear Stearns croaks in February of 2008, and even after the Federal Reserve and the Treasury conspired to take over Fannie and Freddie in July in the peak of the commodities market with nearly $150 oil in the peak. It wasn't until people realized that the central bankers no longer had control of the system when they let Lehman go as a calculated risk that everybody freaked. And I think that allegory stands to give insight as to where we are today.
Well, Eric, well said. And, I can certainly see your case, but I'm on record as saying I thought there would be a significant pullback in the September-October timeframe, and also looking for the metals to catch a bottom during that same time frame. So we'll just have to wait and see in the next couple of months what takes place.
Yeah, and whatever happens, we're still in the end game, whether it's, we have a prequel crash with this large correction of up to 20%, or if we just literally slide right into, shit hit the fan kind of scenario, and the big one, quote unquote, of 2008, 2009 style, if not grander and more profound. I mean, at some point that probably is going to happen, and the only thing that I think is of note and worth looking at in terms of the current market conditions is the fact that there's so many people that are expecting that to be now, basically. I mean, with the Shemitah cycle in particular, literally calling it for this week and next week as being the point where we would have the mother of all crashes. And the way I look at the market signals that are coming out of the market now and the way people are trading in response to the central bank actions that we saw 2 weeks ago, it looks like the conventional finance world is still hanging on. We haven't lost enough confidence yet for that body blow. So time will tell. But, when it comes to how people deal with portfolio insurance, their wealth insurance, and the purpose for owning precious metals, the thesis is the same. I mean, any way you slice it, these are the most crazy financial times I've ever seen in my 25 years in the market. And you've got a heck of a lot more years on your experience, David. And
certainly, I just mentioned that, I mentioned a self-fulfilling prophecy, and I'm old enough to have seen that a couple times, whether that'll take place or not. But Like you said, Eric, once everyone expects it, then usually then the expected doesn't take place. But again, I'm on record with what I said. I'll stand by it. Time will tell. But I want to add on to what you said and just re-verify it. We're getting closer to the edge of the cliff all the time, and no tree grows to the moon. So what this means that at some point something's going to give, and we're seeing it in the silver market. Whether that spills over into the commercial end, certainly over time it will, unless this thing is abated. I mean, I just cheer on the silver investors to continue stacking, continue buying, continue getting silver if you can get it. I would say under $20 an ounce long term, you're going to do fine. You got to remember that the all-in sustaining cost for silver was roughly $20 an ounce when oil was at the $100 level. Now we're at the 45 or so, and that's why you can, the top producers that have the best efficiencies and have their capex pretty much paid for can mine at $15 an ounce and maybe break even at that level. It's only because, well, it's due to several things, but the primary reason is because oil has dropped from the $100 level to the $45 level, because energy is a very big factor in total cost for mining. So that's another thing to keep your eye on. These things are all interconnected, but the biggest fallacy of all of the entire financial world, as you guys stress over and over, is this getting something for nothing, which means you can buy a bond that has value, because it has no value in the end. In fact, I'm so old, as John was jokingly saying, there's a gentleman that was called Franz Pick. You can probably look him up on the Google. I haven't tried in a long time. And he called bonds certificates of guaranteed confiscation. I mean, that's how old I am. But if you look at the history of the bond market, at some point, not always, but at some point, they are certificates of confiscation, because they confiscate your wealth. And that's, of course, what we're seeing. China's dumping the bonds. The Treasury's to 100 billion or so last month, if I remember correctly. So a lot's happening, a lot of dynamics, and it could be an interesting 2 months, or maybe we'll just muddle along for 2 more months. Time will tell.
Well, David, one last question here before we close and wrap up the show this week. We've been talking about tightness in the silver market and delays. When we take a step back and look in the big picture, at least here in the U.S., the average investor is not participating in this market whatsoever. I mean, we're at less than 1%. And we were talking about this with Tom Power last week. I mean, we're way, way, way away from what it could go to in the culmination of a 20-year secular bull market. What do you think is in store for the silver market when that day comes? Retail. I'm talking retail.
No, I agree. I agree with what Greg Hunter said. You'll either have it or you won't. I mean, I've made this point time and time again, and that is, if 1% is invested now, think if 2% were invested. 98% of the people just, have normalcy bias. Everything's wonderful. Watch more TV and, whatever. But only another 1% of the availability of investors come into the precious metals. That would double the demand. And you could not double the demand in the silver market and satisfy everybody with physical metal. It's impossible. So that's where I see it. I think the day will come, as strange and bizarre as that sounds right now. I think it's a distinct possibility. Is it 100% certainty? No, it's not, because price is supposed to be the arbiter of discovery. In other words, I value silver up to $100, but at that level, I rather, trade my silver for, a new car or whatever it is. But in a financial panic situation, or a financial uncertainty situation, or a currency crisis, which I think we're going to see, in those particular circumstances that come very seldom, there will be a time that could, not would, be where people would hold the metal no matter what the price was, because they were too fearful of what the future held. And that would mean, as I said a second ago, that you'd either have it or you wouldn't have it. What do you guys think of that statement?
I think that's totally on target, and we're already seeing signs that institutional investors, big money people, sovereign nations certainly, understand that is our future at some point. It's a question of when, and I think the signals of, for example, backwardation in gold contracts on the LBMA speak to that. There is an awareness amongst at least some financial participants of significant money, be it sovereign nations or big players, or people like Druckenmiller last month taking down gold, albeit with GLD, but nonetheless, you have a pretty significant and well-respected player in the conventional finance world turning towards gold, and those kind of anecdotal stories are on the rise. And I think it speaks to people recognizing that after 4 years of this bear market, that the value proposition, if only for insurance, is there, given the craziness that's in the world. I also was reflecting back the other day, thinking about how in your work, David, you've talked a lot about a movie in 1981 called Rollover, and how the thesis in that movie was a loss of confidence coming out of the Arab world when it came to U.S. treasuries and dumping of treasuries, and having seen just what happened in China and the whole backdrop of the infrastructure developments for a parallel world currency system and trading system, more particularly, not necessarily for the reserve status of the yuan renminbi per se, but the effectuation of trade by China, is putting in this kind of slow motion rollover scenario. It's not quite like the way it was portrayed in 1981 in that movie that you've made reference to so many times in your work. That's really insightful, but it's more along the lines of this kind of evolutionary process where a new concentration of geoeconomic power is on the rise in the United States, and the Anglo-American financial empire is in the decline, and that process is not stoppable. And I think that it will manifest a decline in overall ownership of U.S.-denominated assets over time, and that'll put a bit under precious metals too, and as well as putting pressure on that whole confidence thesis that we were speaking about before that's underpinning the markets. When people lose the faith that the Fed and other central bankers have their back, and when people look at insanity like the Bank of Japan scarfing down over 100% of the issuance of bonds in many given months in the last year and a half. I mean, this is insanity. The kind of things that we have going on in the financial system to keep this this Ponzi going is in many ways unprecedented, and it's pretty scary.
Well, David, it's always a pleasure to have you back. Before we close here, if you can let the listeners know where they can check out your regular work.
You bet. Thank you, Eric and John, for having me on. I'd just like to make note that referencing the Rollover movie, there's another one I was asked, several times on how bad will it get, and the answer is no one really knows. But I like to work in the factual world as much as possible. There is a documentary that was on PBS that's no longer available on PBS, but I found it on YouTube. So we're making it available for free for everybody that signs up for our free list, which is once a week. It comes out every weekend. All you have to do is go to the website, silver-investor.com, scroll down to the bottom, give us a first or last name and an email address. We have to verify that. And once we have that, for the next 4 weeks on our weekend update free e-letter, we will send you the link for this movie. It's called Chapter 5 Argentina, and it goes through the 2001 currency crisis that took place. When you watch that movie, it's about an hour long. You get a pretty good feel for what could happen in other countries, not just the United States, vis-a-vis a currency crisis or basically a default on the outstanding debt. And of course, one of the summations of the movie was, how did this happen? And the answer was overspending.
All right. It's always a pleasure. It's great to have you back, David.